Hi, I'm Stephen Halasnik. Today, what I want to discuss a little bit with you is the difference between a balance sheet and an income statement. When I first started my businesses, I really didn't get it. It took me a long time to understand, the income statement I kind of got a little bit more, but the balance sheet was a little bit more foreign to me. But every business owner should really get in the habit of looking at, an income statement, which, just so you know, in QuickBooks is called a profit and loss statement. And by the way, just so you know, I made the mistake I used to say my profit and loss statement, and someone corrected me and said that's not an industry standard term. The industry standard term is really an income statement. But you should also be looking at your balance sheet. You should be looking at your cash flow statement. You should be looking at your accounts receivable report. You should be looking at your accounts payable report. And you should be looking at your itemized expenses on a monthly basis. If you are running a smaller business, it's just really good practice. It's like, I play a lot of tennis. And, if you learn the importance of the backhand, from every little step, as you become more advanced, it becomes a bigger and bigger deal. So it's the same thing with running a small business. If you get these fundamentals down as your business grows, you'll just do better. And business is risky enough as it is. If you can reduce the risks in your business because you maybe looked at these reports on a monthly basis, that's a smart move to do. So it's a great happy. And the other thing about it is that you'll learn about the itemized things in these reports through time. So as your business grows, the reports will get a little bit more complicated, but you won't be going from 0 to 100 in complexity. You'll be moving along with the complex reports as you go along. So let's kind of talk a little bit about each one of these reports so you understand the value in them too. And the other thing I would tell you is I honestly, at the end of the month, when I was looking at how we did on the month for the month and also from year to date, this was like one of my favorite times because keeping score about your business is a lot of fun. Even if you're doing bad, I guess it's still fun. But keeping score in any type of thing that's the fun part. So it's really a great habit for you to look at these every single month. So let's talk about the balance sheet. The balance sheet shows what your company owns as far as assets and liabilities at any specific moment in time. Even if your balance sheet doesn't say much because you're a young company, it's still a good idea to have it there and look at it and pay attention to it because as you grow, it will become a bigger part. And if there's something you do not understand in any of the reports, Google it. Google it and really read about it. If you don't understand depreciation, Google it and understand it. If you don't understand the difference between liabilities and assets, Google it and really kind of start to really get a better grasp on that. I know it might seem intimidating, some of these reports, but they really are not. And if you just keep doing it, you'll learn from it. Now, the income statement, also known as a profit and loss statement, it shows the revenues and expenses for a period of time, and you should look at that income statement for not only just the month, but you also look at your income statement from a year-to-date perspective, and then also from the same time period a year ago as well, because that will tell you over a period of time. And then there's other reports inside, if you use QuickBooks, that will tell you over a 5-year period. And it really will give you a better understanding. Are your expenses up? Are your sales up? And all these other items. And I'll tell you what I used to do. I actually used to have a cheat sheet. Would have an Excel spreadsheet which would allow me to have certain KPIs, key performance indicators that I really, really zeroed in on. And as my company got bigger, I would make sure my bookkeeper filled that out for me so that I could easily see how we were doing with our KPIs over a long period of time. And I still do that to this day. In fact, I think it's one of the better things that I've learned in business and how to do. Um, the other thing that you kind of need to know is it's you know you, is are you on a cash basis or an accrual basis for your company, and would it be better for you talk to your accountant if you were on a cash basis or an accrual basis? Now, typically, and I don't know what to remember what the amount is. I think it's anything under $5 million now in revenue, and I think now it's higher. Um, you can be on a cash basis, but there is a limit. After you start going over a certain amount, then you should be on an accrual basis. Now, if you are on a cash basis, you can go on to an accrual basis, and there could be some advantages in doing that. Now, what's the difference between a cash and accrual accounting? It lies in the timing of when sales and purchases are recorded in your accounts. So cash accounting recognizes revenue and expenses only when money changes hands, whereas accrual accounting recognizes revenue when it's earned and expenses when they're billed but not paid. So it sounds like a lot, but the best person to talk to about that is your accountant and see if it's better. And in a large majority of cases, it's much better to be on a cash basis. Now, when you're looking at your reports, it is a little bit different when you're on an accrual basis. So you kind of want to know the differences between those two. As far as a cash flow statement goes, that is something that's really, I did a video about this before, and cash flow statement was something I never looked at until I had trouble where I was about to miss payroll. This is a while ago. And then my accountant said, do you look at your cash flow statement? I was like, no, I didn't really know what it was. And your cash flow statement is a regular statement telling you how much cash you have on hand at any specific period of time. It tells you the ups and downs of your cash flow. You'll learn a lot from that. Maybe at certain times of the year, certain times of the month when your cash is down lower and then it pops back up. And all these reports together, when you look at them, really tell you the story of a business. The AR report, the accounts receivable report, gives you great insight into who owes you money and how far they are out. And that's probably one of your more important reports. And I could tell you this. I remember I had this one company who was Inc. 500 fastest growing companies in the United States, and we were dealing with some very, very big numbers. And paying attention to my AR report, we learned that we had a big effect on when clients would pay us. And it was through the simplest little things. In the AR report, what we did was, like an example is if we started seeing our AR go out to 67 days on average before clients were paying us. And we set a goal for ourselves to get that down to 47 days. And so we went through this brainstorming session, my bookkeeper and me and my staff. And we one of the things that we came up with was, well, number one, let's make sure that the invoice is always going to the right person who's supposed to be approving them. Number two, let's make sure we call them after they got the invoice to say, did you get it? And was it logged into their system? And number three is 20 days out, we called our clients to say we wanted to make sure that this is scheduled to be paid. And there was a whole bunch of other things that we did to make sure that these invoices are being paid on time. And I'll tell you, that's what happened. We went from 67 days down to 47 days and made a huge difference in our cash flow. And that was only because we really paid attention to our AR report. The second thing another thing that we looked at a lot was our AP report. And I'll give you an example. AP is your accounts payable report. It's how much money you owe to other people. But, I'll give you an example of one of the things that backfired. I told my bookkeeper, stop paying people on time, pay them out at 60 days or 90 days if you can. We didn't need to, but it's just nice to keep the money in the account. And our bookkeeper at the time, would get bombarded with calls. Why isn't this being paid? And she would have to not pick up the phone and stuff like that. Finally, she came to me and she said, listen, we have the money, we're getting these calls, and then I started getting the calls too. And I said, you know what, let's just pay people on time. And that was always our practice until we, if we ever had an issue with cash flow, maybe it was a little bit different, but we really didn't. We just said, you know what, we're going to pay our bills on time, and that was a big deal. The last report that I would really suggest you look on a monthly basis is an itemized expense report. And the reason for that is in business, it's so different than your personal expenses at home. At home in your personal life, if you spend $100 on something, you really scrutinize it, okay? But if you spend $10,000 or whatever at the business, you may not pay as much attention to it. It's just the numbers are so much more multiplied in the business in regards to expenses than they are versus your personal life. And so because of that, the owner for a small business, let's say under $5 million, should kind of know where your expenses are. And when I say itemized expenses, I probably mean categories, and you can look at your itemized expenses too. And just be aware of those things because, so many business owners are focused on sales, which, they think, I'm going to drive sales. But keep in mind, as you grow as a business person, you start to realize you want to focus on profit. And a big part of profit is your expenses. And if you pay attention and reduce your expenses, then guess what? You have more profit. And that's what we all want, right? That's why we're here. I'd much rather have a company with lower sales, higher profit margins. It's less complicated. So, again, where does this all play to? My company provides an unsecured line of credit to businesses. And as you continue to look over your statements, you'll determine if you need a line of credit. And maybe you'll think of us. But the purpose of a line of credit, regardless if you get it from a commercial bank, if you get it from an alternative lender like us, is that your business will have ups and downs in cash flow, and you should continue to understand the pulse of your business, and these statements and these reports will help you understand if you really do need a line of credit. Personally, over 15 years in the businesses that I have been involved with, longer than that, 15 years, probably 20 years, I've had a line of credit always in place as a cash backup plan. And so it's something for you to consider. So summation of what we're talking about here, pay attention to your statements. All the statements I mentioned, cash flow, income statement, balance sheets, AR report, AP report, and itemized expenses, and you'll be a better business person by doing it. Have a great day. Hope this helps.